Do you ever give product to someone if you don't load it for them? That's, I guess, our question. So say if, you have whatever, their cheese, for example.
Right.
They have the cheese that's packaged. How would they ever give it to a customer without loading it, I guess is the question.
Yeah, and here's the answer. They may, say, have a couple of handlers, a couple of workers, their employees, who can physically load the truck. But if they don't have them, for example, then the carrier hires a couple of guys, and those couple of guys load the product. And they don't touch the product. No one of their employees touches the product. Those only the employers that are hired by the carrier, or a couple of guys that they hire to load the truck, they will be touching the product. They will be responsible, and if they break it during the loading, or step on it or whatever, then this is the responsibility of the buyer. Because the handlers are not the employees of the cheese factory.
So FCA, when does the buyer take ownership then?
That's a really good question. Again, Incoterms has nothing to do with ownership rights. It depends on how you negotiate and what your terms of the contract say. Well, typically the buyer takes ownership when the buyer paid 100% for it.
100%.
Yeah. Well, that's the kind of international rule. You cannot be the owner if you haven't paid for the product yet.
So if I don't get paid for my honey until 30 days after it was shipped, they don't take ownership of that product.
No, legally they are not the owners.
It's my product.
Yeah.
Although they insure it to transport and everything else.
Yeah, that's right. The ownership has nothing to do with it. It's like car loan, right?
But that's not Incoterms then, as far as ownership? Like you're saying, Incoterms doesn't cover ownership.
Doesn't cover ownership.
International, so what regulation says that? That as far as who is ownership once it's paid for?
That's a very good question. As a matter of fact, there is no international rule on that.
Okay.
But there are rules of every country. See some countries with they call it Roman system of law. They have where they have codes, large laws that govern everything. They have civil codes. They call these often civil codes, and those civil codes they regulate how they include many things, but those things include the ownership rights and who becomes the owner and how.
And that's by country?
Yeah, that's from country to country, but just from our experience, in all the countries that we've dealt with, you cannot consider it as the owner until you pay it full. Until you pay the product in full.
So, but then would that not be potentially a legal issue if so you would technically need to know what the civil code is in that country as far as ownership rights.
Yeah.
And so one, obviously you'd have to specify in your contract, but then you would also have to be aware of the civil code.
Yeah, absolutely. The civil codes are some analogy in the other countries. I don't think we have it here in Canada though. We have a little bit different system here though. But yes, you are correct. So you have to know this upfront. You have to make sure that the contract that you put together is compliant to the regulations of the other country.
So Incoterms is only referring to basically the handling of the product. It's not ownership.
Right.
Handling and payment,
Right.
basically.
Right. Okay. One more confusion? I got one for you. just in a minute, but before we move on, I want to make sure that there are no more questions about Incoterms.
So sorry, one more.
Yeah, go
So on back on the container freight. So in their case, if they're handing it off to a customer and selling it to them, say, at Calgary, what we would call FOB Calgary.
Yes.
But basically then if they were just going as far as Calgary, and then their customer was responsible from Calgary forward, they would then be, say, selling an FCA.
Correct.
If they were, say, then delivering it all the way to India, then it would be CFR or CIF, depending on whether they paid the insurance, right?
Yeah, so I think we price that as FCA Calgary.
Right. Compared to if you were doing it delivered to India, then you would be CFR, right?
Yeah, CFR.
The only case here though is you can use CFR or CRF India here, only if you can ship it to, say, nearest port, whatever, whether it's Vancouver or Prince Rupert in this case. What's important though as well is that if you hire the third party to ship it from Calgary to Vancouver, then you can no longer use CFR or CIF.
Yeah, no, I was saying if they were doing ocean freight from Calgary to India, then they would be CFR.
No, there would be either CPT or CIP, because they have to use CN or CP to deliver the rail car to the port of Vancouver.
But they're doing freight all the way to India. That's what I was using as an example. If they were selling it, say,
Right.
to India.
Okay, let me explain from the other angle. So you can only use those those four terms if you deliver the product, if you can deliver the product to the nearest port in your own company means of transport. If you hire a third party to deliver from, say, Calgary to Vancouver and then from Vancouver to India, it's no longer those four rules are no longer applicable because you are hiring a third party. It's the third party responsibility to deliver the product from Calgary to Vancouver. In this case, it's either CPT or CIP.
So if you use a freight forwarder to move it from Calgary to India, it's not CFR or CF.
No, you can only use it if you have, let's say, your company has a truck, and you load the truck, and it's your responsibility of your company. You as a seller, it's your responsibility. You deliver it to Vancouver port, and then you give the product to the handlers in port of Vancouver. All right. Yeah, I know it's not easy, but this is something that you need to know. You need to make sure that you can interpret the terms. If you are importing stuff from other country, you should also ask your importer to put together a quote in Incoterms format. And when that happens, you can look at the chart and you can interpret what sort of cost you expect that your seller will arrange, and what sort of cost that you have to arrange. The other component of pricing for international trade is the harmonized system codes. The harmonized system codes, they represent the codes assigned to each and every physical product. So what happened that people got together many years ago and they classified all the physical products into the categories and subcategories and subcategories. So there is up to 10 digits in every single code that represents every single product. The first 6 digits are universal around the world. In particular, you use this information to determine trade barriers. And remember yesterday when we worked on Industry Canada database and on WTO databases, did you notice that there are 6 digits allocated to every product that you dealt with? Did you notice that?
Some have more though.
Yeah, some have more, but they may have more. They may have up to 10. But the first 6 are universal around the world. So if you need to determine, let's say, the customs duty in the other country, you can use only those 6 digits, and you're going to get the result. you can get the information. There's a website where you can get the HS codes, international HS code. It's kind of an independent website. You can also get it from Industry Canada, Trade Data Online, the one that we used yesterday. Now, how you practically use all this information? You use this information by applying this information to the costing model. Well, obviously, when you price the product for international trade, you not only rely on your costs. For example, you can price based on your competitors' pricing, say based on the fact whether you have a monopoly on the market or not. But strictly from the costing perspective, this is the model right here in the slide. You have certain cost of goods. You have sales taxes that you may pay in Canada for these products or for the components of these products. In the pricing for international trade, you're supposed to deduct it. And I will explain later why, just on the next slide, why you should deduct it, but this is the rule. This is the international rule. Every exporter that exports the product to the export market must deduct all sales taxes that were accumulated in order to produce this product. And then depending on the Incoterms, you add packaging costs. For example, obviously you add your profit margin. It has nothing to do with Incoterms, but it's just common sense. If it's EXW term, then when you quote price to the buyer in the other country, you only include cost of goods, profit margin, and packaging cost. If you quote on, let's say, cost insurance, carriage and insurance paid, CIP term, then you add all the costs of, let's say, inspection, delivery to the port, shipment, insurance. If you sell on D terms, then you add pretty much everything. You may not necessarily add import duties. It's only if you sell on DTP terms, then you add import duties. If you sell on, say, DAT or DAP term, you include delivery to the buyer, unloading, but you do not include import duties. Any questions on applying costing model? So if we go back to Incoterms, how do you typically sell? Let's say if you look at your traditional terms of sales, what would be your preferred Incoterms? Yeah, that's most of you probably do ex-work sales. Those of you who arrange transportation, you sell probably on C terms, well, either of C terms. If you don't buy insurance, I suggest you do that.
In our market, a lot of the international canola oil goes under CIF.
Mm-hmm.
And that's where I guess I was confused, because a lot of the industry uses CIF.
Yep. Yeah.
But it comes out of here.
Yep.
As CIF, right?
Mm-hmm. Yeah.
So
CIF may only be
it's
used.
replace CIF, right?
Yeah, we haven't done any of it yet.
Yeah, if it's let's say CIF, then what happens is that as a seller, you are responsible for the shipment from Calgary to the port. And it wouldn't even be considered a part of international transaction.
But then you said if it's a third party doing the shipping, then it's not CIF, right?
Sorry?
You said that if it's
Yeah,
a
yeah,
third
exactly.
party
Yeah,
shipping.
that's right. So if it's a third party, then it's either
Because
CIF
like
or
obviously
CIF.
everyone pretty much uses a third party, like they're not.
Yeah, exactly.
But a lot of people still use CIF even though
Yep,
they're doing
yep,
third party.
exactly.
So
That's why, as I mentioned, so what you see in the brackets is critically important. Because if you say use a CIF term and you use it like CIF Calgary, then what will happen in reality is that it will be transformed into CIP if there's a dispute or any concerns. Okay, so we'll now talk about more of a confusing stuff. Pricing is very important, and it's very important to understand all the nuances. So this is a reference to this particular item when you deduct sales taxes from the cost of goods, and here I'm going to explain why. So, oops. So the rule is, this rule applies because most of the countries around the world, they have their own sales taxes. And if you were to charge your customer overseas, if you were to include your Canadian sales taxes, then their country will also apply their sales taxes on top of Canadian sales taxes. And it would have been double taxation. It would have been just a lot of money that paid, and it could make the product non-competitive. So that's why there's an international rule that as an exporter you deduct all the sales taxes that were accumulated during the production, or say when you just purchased the product from other Canadian company and sell it to the other market. You're supposed to deduct, although you have, say in this example, the product costed $100, and you've paid $105 because $5 is the GST. When you invoice for a customer, you invoice only $100. You invoice only the cost of goods. Then what happens that when it comes to your sales tax sales tax reporting period, typically it's once a year. In some companies it's 4 times a year, but in most of your cases probably once a year. So once a year when you submit your sales tax claim to CRA, the CRA will reimburse that tax back to you. And the importer will pay their own sales taxes, only on top of the price of product that is clear of any Canadian sales taxes. Again, most of the countries have sales taxes. United States, for example, doesn't have the federal sales tax. They have many provincial sales taxes in some provinces, but they don't have federal, but most of the countries do. And even though United States, they don't have this sales tax, you're still supposed to deduct all Canadian taxes. And this is where financing is important, because you have to deduct sales tax that you've paid in Canada, but you still paid it, right? And you have to find some ways to reimburse this gap, bridge this gap up until time comes when the CRA will give you this money back. Is that clear? If your product, for whatever reason, there are some products in Canada that are 0 rated, or sales tax do not apply. In this case, that's fine. You don't have to bother about it.
In agriculture.
Yeah. Okay. Any questions on pricing? We're done with pricing, so maybe if you have questions on topics that we discussed earlier with regards to the pricing. Okay, so we'll cover two more. Oh, sure, sorry.
So, I know a lot of people buy products from all over and then make their products to be.
Mm-hmm.
You pay taxes sometimes from other countries, like the VAT tax, what I pay anyways.
Mm-hmm.
How do you minus that out? Like,
Is your importer charging you Vietnamese VAT?
Well,
They-
well,
they
I
should.
need to talk, well, yes. but-
Yeah, they should.
It's, they shouldn't, but if you actually, they have different rules, but, and that's why I'm a little confused, like,
Mhm.
if something is transferred, say you buy a product, and this, I'm just using my scenario.
Right,
it would
right.
be the same
Mhm.
scenario here. So say you buy a product and somebody just uses it here,
Mhm.
like oil, okay? And you need the oil to produce something else.
Mhm.
The oil you have to pay for has, it could be 5%, but we know
Mhm,
it,
mhm.
whatever it is, right?
Mhm.
So overseas, because it's transferred from one warehouse to another, I don't know, like my bags, for instance, something like that.
Mhm.
Okay, so my bags are made, say in Vietnam, it's transferred to my plant, but then
Mhm.
everything I need to have that is exported. I don't have a bag, I can't export my product. So they're charging VAT on that, or VAT on flavor or something like that. Is that the same also in Canada? Like, I'm using both scenarios, but, like, I mean, there's different taxes if you're buying here, like some people need bags, you have to pay tax on bags here too.
Oh, I see, I see.
So in order to, or a bottle or something like that, so is that, how do you take,
No,
because I'm using my scenario, but it
Mhm.
would probably be the same here too. Because I'm paying VAT tax on my bags.
Yeah,
because
but
it's transferred.
just a tax on bags, right? So some sort of, I don't know, ecology
It's a lot,
or
though.
environmental tax, right?
It's
So,
10%, that's a lot.
but are you sure that it's the environmental tax? It's not the sales tax?
Sales tax, that.
It's sales tax, yeah, it's VAT, right? Value added tax. So, you should not really do that.
Would be.
Yeah, exactly. So,
Why would I take that out for, like, I'm exporting?
no. Wait a second. You are importing this product from Vietnam to Canada, right? Right. So let's say your product in Vietnam costs $100, and there's Vietnamese sales tax 10%. So your importer in Vietnam, when they invoice you, they were supposed to get this $10, 10% their sales tax from their government back when they export.
They should.
They should, but they don't do that. Right? They don't do that. They don't do that because they need cash, and they cannot wait a year, wait 1 year before their tax authority will process their claim. Yeah, this is what is happening. If I were you, I would try to talk to any of the tax consulting firms, like BDO, MNP, those folks. So those accounting firms that have international taxation departments, because what happens that you are actually double taxed. Because you pay Vietnamese VAT, and then you also pay GST when your product comes to Canada, correct? Well, you cannot import anything to Canada. You cannot release the product unless you pay 5%. So in this case, you are double taxed. This is not right. You should really talk to one of those accounting firms.
Yeah, I was asking it for the reason of, like, if I import and package or stuff here,
Mhm.
I'm not charged, it's completely exported, because I'm transferring it in the country, I have to pay. So it would be the same if you buy like a bottle, like you're making a sauce here, like, or you know, you have a packaging, you're packaging in terms of GST, so how did, you're gonna have to put the packaging, right? But I'm trying to understand, you just said that, because not everything is, like, you need a package, if she has space and she'll put in a bottle, she buys a bottle.
Yeah. So
She's gonna have to take out the.
yeah, to take out tax that you paid for the bottle, take out the tax you paid for all the ingredients. Yeah. Yeah, but you say if your product has multiple components and you paid GST to buy these components, yeah, you are supposed to deduct them and get the reimbursement from CRA. But in your case, I strongly recommend you to talk to international tax professionals. Yeah, because you're double taxed, it's not right. So maybe you can get some reimbursement from, I don't know, well, it's unlikely from Vietnam, but maybe from Canada Revenue Agency. Mhm.
I just brought it up.
Yeah, it's very good. It's very good. Okay, so we just have a couple of items to go, and I'll let you. I'll give you some. I'll give you a 15 minutes break. Very quickly, place component. So this is this component is about how you deliver your products and how you and where and by what means. Well, it's very straightforward for international trade. So those are mode of transportation that are available, or it's a combination of those modes. It's called a multimodal transportation if it's a combination of 2 or more modes of transport. Those 2 slides, this one and the next one, it's just the reference information for you. We're not going to stop here. I just wanted to explain that when you deal with freight forwarders and customs brokers, there's typically a lot of communication back and forth. So on these 2 slides, I put together all pieces of information that you need to provide to your freight forwarder or customs broker in order to get the quote fast. Otherwise, if you provide only half of this information, there's going to be exchange of emails or calls back and forth, and